All right, folks, part 3 from chapter 1. Let's take a look at these different statements, okay? All right, so the first one, income statement. Couple things to notice here. First, look, here's the name of the company up top. Let me get my pen here. Okay, right here, name of the company, Noodle Cake Studios, right here. Okay, so there's the name of the company. Income statement. Okay, now notice it says projected. Don't worry about that for right now, but that's the income statement. And notice it says for the month ended, September 30th, 2021. So what that means is that this is for a period of time. It's not for one date, but for a whole month. Okay, that could be for a month, for a quarter of the year, could be for half the year, but they'll tell you whatever period. Now notice what we have. What's our income statement? Revenues minus expenses gives us equals net income. So we had revenues of $12,000. Now notice they have two different types of revenues. They have a sales revenue and a service revenue. And by the way, every company can decide what different types of revenues they want to have. I mean, let me give you an example. Let's say you had a restaurant and you had, regular meals, then you had appetizers, and let's say you had alcohol. In order to run your business properly, you might want to know how much came from regular meals, how much came from appetizers, and how much came from alcohol, right? So it will be important to have those numbers separate. Then we have all the expenses. Now notice, all of them end in expense, right? All of them end in the word expense. So anything that ends in expense, guess what? It's an expense. So we did $12,000 in revenue. We had $10,000, right? And so we had net income of $2,000. Now the question is, what are we going to do with that net income? Okay? Are we going to pay some dividends out of it later or not? Okay? So there you go. That's the income statement. Revenues minus expenses equal net income. And notice that it's for a period of time. Okay? All right? By the way, the unit of measure assumption, what they're saying there, unit of measure assumption, you need to tell it, what are you measuring? Here it's dollars, but it could be euros, could be yen. I don't know if you've ever seen any of these, but you have to tell it, how are you measuring it? Okay? So I got to know what kind of money you're talking about. That's all that means. Okay? All right, here's question number 5. What does the income statement show? Hopefully you know this by now. What does the income statement show? So make sure you grab your sheet of paper and answer that question because it's on your quiz. All right. The next one now, this one's going to be a little different. This one's the statement of retained earnings. So if you remember what retained earnings are the money we keep in our business. We made the money, but we didn't spend it. So let's take a look. Again, name of the business up at the top. Then we got the name of the statement of retained earnings. And again, notice for a period of time, for the same month. Now look what they show us here. Retained earnings, we started at 0. So that usually, when you see one starting at 0, that generally means they just started business, right? Now you add net income. That came from the income statement we just saw. There's the $2,000. Then we subtract the dividends for 1,000. So our retained earnings at the end is $1,000. Okay? So in this case, so what happened? We made 2,000, right? But we gave 1,000 out as dividends, and 1,000 we kept as retained earnings. Okay? So basically it shows, or statement of retained earnings shows what happened to your retained earnings. By the way, for most companies that are making money, should you expect the retained earnings statement to increase or to decrease? Well, normally you would expect it to increase, right? If you're making money, you can't give it all. You usually won't give it all out as dividends because you want to hold on to some in case you need to invest in other things. So normally you would expect to see this number increase. Okay? All right. Question number 6. What are retained earnings? Okay? There you go. There's questions. What are these guys? What are these retained earnings? Okay? What are they? Okay? Hopefully you know the answer to that one. Again, question number 6. Don't forget, it's on your quiz. All right, next one we're going to take a look is at the balance sheet. Now this one, again, notice our name up at the top, right here. And they tell you the name of the financial statement. But notice here it says at September 30th. So notice it's at a point in time. It's at a point in time. It's not for a period of time. It's on one day. One day. And remember, the balance sheet, assets equal liability plus stockholders' equity. So if we take a look, our total assets here are $36,000. Our liabilities here are $25,000. And our stockholders' equity is 11. So we got 36 equals 36. You see how it's equal? Has to be equal. By the way, when you look at these assets here, the assets are put in what's called order of liquidity. Now you're probably going, well, what the heck does that mean? Well, order of liquidity means how close is it to being cash? In other words, to be liquid means that you have it in cash. So for example, let's say you own a lot of land. That can make you wealthy, but you might not have any cash. So liquidity has to do with how fast can it be turned into cash. And so cash is definitely cash. That's at the top. Now, accounts receivable, that's when somebody owes you money. Now, you got to collect the money, but you can also sell those. And then it goes down from there. So the first few for sure. And then supplies, well, you have to sell that stuff. But anyway, order of liquidity. Now, if you take a look at liabilities, notice we have two here, accounts payable, and then we have notes payable. Now, what they normally do here is they separate them into short-term and long-term. So an account payable would be like, let's say you bought, like UNCP bought stuff from Staples, and they want to get paid in 30 days. That's short-term. That's an account payable. But let's say UNCP borrowed $5 million from Lumber Guarantee Bank. They would sign a note, and that would be note payable long-term. So again, they separate them, and later on in finance, you'll understand why that's important. Okay? And then finally, stockholders' equity. Notice we have two parts. Common stock, right here, this $10,000, that's from the original sale. Then remember the retained earnings, that was $1,000. Remember we made $2,000. We made $2,000, but we kept $1,000 in retained earnings. So the total here is 11. And then you take that 11 plus this 25 gives you 36. So remember, balance sheet, point in time. Assets equal liabilities plus stockholders' equity. Okay? Okay, there you go, accounting equation. So here you go, another question. I'm not sure if this is the right question number. Let me go back and see. The other one was question 6. Can I go back? Let's see if I can go back. So if that was question 6, that was question 5. This is actually question 7. This is actually question 7. Pretty sure it's question 7. The balance sheet reports assets, liabilities, and stockholders' equity at, and now you got to say, what time does it report them at? Okay? Again, question number 7. Make sure you write it down for your quiz. All right. Last one here, statement of cash flows. Now, this one is a little bit different. This is all about cash. So what we want to know is what happened to our cash. Okay? So, again, notice the name of the company up here at the top. Okay? Then the name of the statement. And again, notice for the month ended. So one thing to remember is there's only one statement that's at a point in time. There's only one of them. Every other one is for a period of time. The one that's at a point in time, that's the balance sheet. Okay? So let's take a look here. It says cash flow from operating activities. Now, operating activities are the basic business. So let me give you an example. Let's say you were looking at a Subway sandwich shop. Now, how does Subway make money? Okay? They sell sub sandwiches, they sell chips, they sell cookies, wraps, stuff like that, right? That's their main business, right? So notice it says cash received from companies, cash paid to employees and suppliers. So notice they have a positive number there. By the way, this number has better be positive. It had better be positive. Now, in the short run, it can be negative. But in the long run, if a company doesn't make money from its basic business, it's not going to stay in business. Does that make sense? If you have a restaurant or if you have an auto repair shop and you're not making money repairing cars, how long are you going to stay in business? So operating activities, that has to be positive. Now, the next one is from investing activities. Now, what investing activities are is a company makes money and then they need to go and buy things, equipment or whatever. So notice cash used to buy equipment or software. So normally, you see how this is a negative number? Normally, you'd like to see a negative number there because that means you made money or borrowed money or got money somehow and you used it to buy stuff for your business. Okay? So you would normally expect to see a negative number there. Now, you could see a positive number there. What that would mean would be you sold some of your equipment or you sold some of your software or some of your assets. Now, the thing is, that's okay if you didn't need it. So let me give you an example. Let's say you opened up your Subway sandwich shop and you bought 4 ovens to cook the bread in. But after owning it for a year or two, you're like, wow, I really don't need 4 ovens. I only need 3. Well, then if you sold one oven, it's not too bad, right? So if that made it positive, that's not too bad. But what would happen if you couldn't make your payroll and you sold your oven so you could pay your employees? That's completely different. See the difference? Okay. So normally you would expect to see a minus sign. Now, finally, cash flows from financing activities. Let me show you this one. Okay. Cash flows from financing activities. Now, what this is about, financing activities, cash received from stock. So we got money from selling our stock. We got $10,000 from that. Then we paid some dividends to our stockholders. Remember, we said that for $1,000. Then we borrowed money from the bank. So the thing is, what number should you expect to see here? Well, you really can't say. Both a positive number could be good and a negative number could be good. You just have to look at the details. So for example, why is that 10,000 positive number good? Well, that means somebody was willing to buy your stock. That's a good thing, right? Why is the negative number for the dividends good? Well, that means you made money and you paid dividends, so that's good. What about cash borrowed from the bank, 20,000, right? That positive number there, you borrowed money. Well, what's the good news there? The good news is the bank thought enough of you to lend you the money, okay? So anyway, you have this 4,000, you have this negative 20, you have 29, so your change in cash is 13. And the reason why, you say, well, where change in cash is 13, right? Beginning cash balance was 0. Our ending cash balance is $13,000. And by the way, this number matches up to what's on the balance sheet. Okay? All right, folks, I'm going to stop it there. We'll be back with another part in just a minute.